targets with your team, sales team, the annual target, the revenue they are going to do for you, and the action plan and roadmap to achieve those numbers? Have you set up a plan? How much EBITDA, how much margins are you going to make in this year? Have you set up targets for your business? How much cash from the operations are you going to make this year? Do you have a mechanism in place to price your product in this competitive market? And finally, do you have a performance review mechanism where you set performance benchmark and assess your performance against those numbers so that your performance is aligned with your targets or not? Well, budgeting is your answer. Now, when you do budgeting, you should be aware about seven things. There are seven levers which contribute to business, seven key levers. Let me introduce those levers to you. These levers are sales, cost of goods sold. Again, cost of goods sold is nothing but purchases adjusted of stock. That is the actual material that you have sold, cost of that material. Third lever being direct expenses, and fourth lever being fixed expenses. Now, these four level predominantly contributes to your margin, but the story doesn't end here. The story doesn't end here. What you have to do is you also have to assess how much of this margin are you gonna earn and collect in your bank account. This particular piece is called working capital management. So there are three contributors for your business which contributes to working capital. The first being debtor, second being creditor, and third being inventory. So to assess how much money, to assess you have made the sale, but you have not been able to collect those money in time, the amount is outstanding in debtors. There is a ratio to measure it, which is called debtor turnover ratio, which means the speed with which you are collecting the money after making a sale. Similarly, inventory. You have made the purchases, the inventory is sitting in your stocks. Now, since you have not been able to sold those inventory, that money is stuck in inventory. And the third piece, which is creditor or trade payable, please understand that the way with which your customer holds on to your money, you hold on to your vendor's money. Now, mathematically speaking, this makes sense to hold your vendor's money to make sure that you have money at your disposal, but it is not advisable because then vendors are someone who can hamper your production cycle by affecting your procurement significantly. So when you adjust these three turnovers from your margins, what you get is the target of how much cash your business is going to generate. And trust me, guys, that's what matters. Now let's understand how to go about budgeting. Since for all these seven levers, you have to budget, you have to plan at the beginning of the year. First piece being sales. Let's understand how to budget sales in a little detail. Okay, so first, what you have to understand is segmentation of sales. In order to assess, traits of your sales, segmentation is the best way. For example, you are working with multiple products, 3 products, 4 products, 5 products. These products becomes a segment for you. You might be working across geography, multiple geography. Geography division is also a segment, or your customer characteristics is varied upon multiple industries. So each and every industry, for example, you have your customer base in BFSI, FMCG, or some other vertical, these become segment. Now, it is very important to divide, to drive, and to design your sales team according to the segment. Would like to discuss a case study here, a very small case study. We were working with a flexo printer manufacturer in Ahmedabad, and their model was such they used to sell two machines. One costed around 5 lakh, 6 lakh rupees, and the another one costed around 45 to 50 lakh rupees. Their segmentation was such that they had geographical segmentation. That means if a person who is owning a particular geography, he was making a sell for both those products in that geography. They had an incentive policy whereby the person will get 1% of the sale value that he realized. So automatically the same person was more inclined towards making of a sale of a product that worth 50 lakhs. Now a little backstory to it. If you'll see, the product which costed 50 lakh rupees was actually only contributing to the tune of 10% to 13% in terms of margin. Whereas the product which was being sold for 5 lakh rupees was contributing up to 40-50%. On further assessment, we saw a trend that the person who was buying, the customer who was buying the product worth 50 lakh rupees was not interested in the product worth 5 lakh rupees and vice versa. Being into that line, what we have done, we have changed the segmentation, and what we did was we created product owners instead of geography owners. We created product owners, and through this way we were able to revive the product which was worth 5 lakh rupees, and the sale picked up, and soon this business is going to be debt free. So the first piece, when you have identified that what all segments break up, that works for you, the second piece is bucketing under in that segment. Now, why bucketing is important? Because the approach for each and every bucket differs. For example, the first bucket is existing customer, existing business. Now, what you do here, you identify your recurring customers. See, if they are in business, they are working with you, they have bought material or took services from you in past year, and they are satisfied with your services and commercial term, there is no reason that they why will not why won't they come again back to you. Okay, you will not have to spend any penny on marketing or advertisement on this bucket particularly. You should expect an 80%, 80 to 90% target achievement from this bucket, the bucket one, which is existing customer, existing revenue. Second bucket being existing customer and new business. If you plan to launch a new product or a new services, your existing customers are the best customers to take feedback from. They'll probably try that product without you spending anything on marketing or advertisement. The third bucket being is entirely about new customer. Your entire marketing, advertisement, exhibition spend, everything, the efficiency of all those expense is derived how your bucket three performs. Okay, with bucket one, bucket two, bucket three in place, this becomes the Bible for your sales team. Against these numbers, you got to measure actual performance month on month. Now, this is how you budget your sales. Next piece is cost of goods sold. Based on segmental breakup, based on product level breakup, you need to assess how much are you going to spend in terms of purchase of that particular product. That will become the cost of your goods sold. Third lever, which is direct expenses. Now, these expenses are directly related to sales, production, and procurement of your particular product or services. You need to estimate how much are you gonna incur to make the sell of number of products what you have agreed. Now, by this time, you have derived the GP margins at a product level. That becomes the KPI for your business. Then, if you achieve that level of sale, this is going to be the gross margins that you are gonna make. Now, fourth lever being indirect expenses, or you may call it fixed expenses. These are more or less committed costs. You need to assess the efficiency of those costs, that they contribute enough for sales or any function which is above the gross profit level. For example, if you have salary expenses, you should see your competitors, how much are they spending and what kind of returns are they getting in terms of gross margins and net margins. Typical examples of fixed costs or indirect costs are your rent, your salaries, your utilities, your interest that you pay to your bank. With with these four levers planned out, what you get is your earning, which is profit before tax. As we have discussed previously, the story just doesn't end here. Unless the earned money is collected in your bank account, the money is not actually made. Okay, you have made a sale. Probably, if you have not made a timely collection from your debtor, the money is sitting with your debtor. The money is sitting in form of inventory, or you, due to that reason, you have held upon the money that you should have paid to your creditors. Now, it is very important to set a target in terms of how quickly are you going to realize this money from your debtor parties. There are ways and means in the market: vendor financing, bill discounting, income taxation, which works in your favor, in the MSME's favor, which work toward boosting your collection pattern. Similarly, inventory turnover. Now, the speed with which you are churning out your inventory is your inventory turnover. You should be looking at your inventory periodically, based on a periodical basis, that dead inventory is not jamming up in your stores. And if it is jamming up, figure out a strategy plan to move out of that and realize it to cash. The third thing is creditors. It is very important to manage your vendor. Please understand, Please become a critical customer to your vendor so that your procurements are in time and your entire sales and working capital cycle is in order. When you set up targets in this term, what you derive at targets in terms of how much cash is your business gonna generate, or how much cash your operations are gonna generate for you. This is the way you should be preparing your budgets. And the most important thing, you should be reviewing the actual performance of these levers on a monthly basis to get a grip on your business number wise. You should be reviewing it on a monthly basis to understand that which particular lever needs a course correction, take a corrective action so that ultimately you achieve the intended margins. If you have this mechanism in place, trust me, you can have a control of your business on your tips. Now, we are a group of chartered accountants. Our goal is to create, build cash rich, scalable business for businesses using the most effective tool, probably, that is numbers. We set up performance benchmarks and structures of review mechanisms so that your goal, you never lose a sight of your goal and you end up achieving the targets in terms of margins and cash conversions from your business. We also assist with continuous data analytics so that you take data driven decisions for your business. So, if you would like a tailor made growth plan for your business, please get in touch. Below is the link. Please book a call with us with the link given below. Looking forward to connecting with you all soon. Thank you.